All right. Thanks everyone for joining our speaker series today. And in this, through these speaker series, we try to bring in subject matter experts in the real estate investing space. So I'm delighted to have Taylor Loht join us today. What I found really interesting about Taylor's background is he's one among us working full time, and then also kicked off his real estate investing career as a syndicator, working as a general partner in investments. So few folks in this group have asked about syndications, have been interested how to get started in syndications, grow their real estate investment career from whatever investments that they were doing. So I thought Taylor has quite a few number of things that he can share with us, and and we can learn quite a bit from him as well. So with that, Taylor, I'd love to hand it off to you and take us through your journey, and we would love to learn more from you.
Awesome. Well, thanks so much. Thanks for the intro, and thanks for the opportunity to speak with you guys today and share my experience and some of the things that I've learned along the way. Definitely open to taking questions, whether you throw them in the chat or save them till the end, whatever. I'll try to keep an eye on it, and feel free to interrupt me. I'm, pretty open to that stuff. I will share my screen here. All righty, let's see, get that squared up. All righty, looks like I'm good there. Get an eye on the time. And so I'll talk today about breaking into real estate syndication. I'll tell you all a little bit about myself and what I do and all that kind of a thing here as we run through. And like I said, definitely open to questions, any that you like. So first off, little disclaimer and disclosure. This is the only reading off a slide I'm going to do, and then we'll get into the topic. But this presentation is for informational purposes only. It's not investment advice and does not constitute a recommendation of any kind. There's no offer to sell, nor a solicitation of an offer to buy any security. Any real estate investing that you do is done at your own risk and always carries a risk of loss. Securities, my business, are offered through Phase 1 Financial Services, member FINRA SIPC. NT Capital is my company, and Phase 1 Financial Services are not affiliated entities. All right, so I'll get into it. So who I am, I'm a blue hen. I attended the University of Delaware many years ago now, got a degree in chemical engineering, and that got me started in the professional world. I had a few nickels to rub together, and that's how I started investing in general. And then eventually I shifted over to being a real estate investor. I live in Richmond, Virginia with my fiance, Sandra. She's right there. She teaches at an inner city school, so she's at school right now. We have 3 cats. One of them is sitting on my lap right now, and I'm sure they'll be making an appearance here during our conversation. And very passionate about Brazilian Jiu-Jitsu. I started training in 2015, got my purple belt back over the summer, and always working through injuries, but try to train as much as I can and, remain active. It's one of my favorite things to do. So how I do real estate, as I mentioned before, my company is NT Capital. Personally, I've acquired, partnered, invested in, or otherwise been involved with $150 to $200 million in commercial real estate. And, right now I'm raising capital for various deals, and I host the Passive Wealth Strategy Show, 3-day-a-week podcast, Monday, Tuesday, and Thursday, where we help the listeners escape the Wall Street casino and build wealth on Main Street by investing in real estate. There are a lot of ways to invest in real estate. Today, we're going to talk about real estate syndication. Just a couple recent examples of deals and things that I invested and that we work on. Larger apartment complexes in solid markets. Personally, apartment complexes that I invest in, I prefer B-class, 1980s build or newer, with several hundred units, preferably minimum of about 150. And getting a cat off my lap there. As I mentioned, there will be cats involved today. So getting started in syndication, really, I'm going to walk you through a step-by-step model that I use this model, but also, it's been adapted, and I've interviewed several hundred real estate investors and syndicators. And this is a solid, I believe, a solid on-ramp into the real estate syndication space, not just multifamily. There are a lot of things that you can syndicate. We'll go through that in a little bit here. So first up, we'll go through the model here. But first thing that you need to do if you want to syndicate real estate is you need to learn the rules around raising capital from passive investors. So in any real estate syndication, there are two parties involved generally, and each party can be multiple people. But first up, you have the active investor. Sometimes it's called the general partner, the sponsor, the operator. There are a lot of terms around it, but the active investor, general partner, those are the people or the person who are doing the deal. They're going and finding the deal. They're raising the money. They're managing it. They're selling it. They're getting it financed. They're the ones doing in the work and, putting in the hours to make the deal happen. On the other side, you have passive investors, also called limited partners. There are fewer terms for them, but their participation is limited to their investment. They're not putting any time into the deal. They're just getting reports from the general partner on a monthly or quarterly basis, reviewing those, receiving distributions and all that kind of a thing, but not actively participating in the deal. This conversation is going to focus primarily on the active side of real estate syndication and getting into that. But in order to do that, if you want to be on the active side and you want to raise capital from passive investors, you got to follow a lot of rules. The government has a lot of things to say about what we need to do if we want to bring passive investors into any kind of investment, not just real estate. And the real estate syndication space primarily runs on utilizes two exemptions to registration of the securities with the SEC. You'll hear these bandied back and forth, the Reg D Rule 506B or Reg D Rule 506C. You need a securities attorney to do these things. Remember, this is not legal advice of any kind. You need an attorney to help you with these things. Just going to talk about a few of the pros and cons or advantages and disadvantages of each one and things that you need to think about if you're going to use these exemptions. So Rule 506B, first off, allows us to raise capital from accredited and non-accredited sophisticated investors up to 35 non-accredited sophisticated investors, but we need to have a pre-existing substantive relationship with our investors, and we can't advertise our deals publicly. On the other hand, 506C allows us to publicly advertise, but we can only raise capital from an unlimited number of accredited investors, and we have to get a third party to verify that those investors are accredited. The business decision that a lot of folks run up against when they're deciding 506B versus 506C really comes down to that conversation around advertising and non-accredited sophisticated investors. Newer syndicators will oftentimes have an investor base that has a lot of non-accredited sophisticated investors in it. So they will tend to lean toward 506B. Also, when you're getting started out, you might not have the footprint to make 506C and the public advertising, the ability to publicly advertise it might not be able to make it worth it. So a lot of folks actually kind of counterintuitively will start with 506B and move to 506C. There's not like a requirement to do that. Really, the point I'm making here is learn the rules, learn the detailed nuances between each one before you get into this business, no matter what you do.
And Taylor, if you don't mind, for the audience, can you explain what it means to be an accredited investor?
Yeah, absolutely. So there are a few different ways to qualify. The two big ones are either net worth or annual income. To be an accredited investor, you have to have a net worth of $1 million or more, excluding the equity in your primary residence, or an annual income of, don't quote me on these numbers, but over $200,000 for an individual or over $300,000 for a married couple. And that's for the previous 2 years and a reasonable expectation that you'll have that for the current year and moving into the future. Refer to the SEC's page on that if you need additional details. There are other ways to qualify. You can have certain securities licenses that'll get you to qualify, but primarily most folks will qualify under either the net worth or income requirements. Excuse me, 1 second. Okay. So next you need to learn the business, and really in my mind, there are kind of two halves of this situation. So you need to learn the rules and how the securities part of the things work, but you also need to learn how you're going to execute on whatever type of deal you want to do. Now, I mentioned before, I primarily invest in value add multifamily, but there are a lot of things out there in the real estate world that you can invest in. I also invest in self-storage, completely different business from multifamily. I know folks who do ground up construction of multifamily. Again, completely different business from the value add strategy that I use, and then, expanding mobile home parks, all that kind of a thing. And whichever way you want to go, you need to learn the business. There are a lot of ways that you can do that. I think probably the most popular way to get started is by doing deals yourself, doing deals where you have enough capital to go do it on your own. If you want to do multifamily, maybe start with a 10-unit apartment complex or something that you can come up with the capital on your own, not have to raise from passive investors, so that you can get the practice of going through things and managing a deal, all that type of a thing. Or if you're self-storage, go buy a small self-storage facility on your own. I think doing deals yourself is really a great way to get started, build your track record, build something that you can show to people and say, hey, I've done this deal in the past, that kind of a thing, build your resume in the real estate space. But of course, it's not the only way to learn. There are a lot of books, and I've got a few behind me. I've got several other bookshelves here in my office, and there are really books around whatever you want to do in the real estate space. There's a ton on multifamily, but it's not just multifamily. Want to make sure I'm pointing the right direction here. Self-storage book right there, and there are several others available. Podcasts are a great way to learn. Now, both of those are not going to stack up to going and doing deals yourself, or you're going to learn the most by doing. You can learn academically. Events are great. There are so many multifamily events out there, but again, they're self-storage and mobile home park events. Mentoring, you can pay mentors. You can kind of have more informal, unpaid mentorships. So for the paid mentors in the multifamily space, they can get pricey. Some of them could be $20,000 to $50,000 plus to hire somebody to be your mentor and look over your shoulder. And that's somebody with generally a pretty substantial track record. But in my opinion, that's something to do after you've really learned at least the basics. You don't want to pay somebody $20,000 to $50,000 to learn something that you could have paid $500 to $1,000 to learn on your own and do that studying. But having somebody experienced looking over your shoulder can definitely be beneficial. So something to think about. And then passive investing is a great way to learn. There's a limited amount that you're going to learn as a passive investor. That's actually how I got started in the syndication space. Is I learned from books and podcasts and everything. But my first foot in the water was as a passive investor. I had capital, found a deal that I thought was interesting, a sponsor that I thought would do a good job, and I passively invested. And you can learn that way. But again, you're going to learn the most by actually going and doing deals. So now we've done the education part, right? That's big, getting educated. But real estate is about making decisions, committing, and taking action. So now we're going to move on to the decisions and action taking portion of the conversation. Most people really fail in real estate because they fail to launch. They fail to make definitive decisions and take action, and they just kind of float around, chase shiny objects. So next thing you're going to do once you learn the business is you need to pick your asset class. So again, I talk about multifamily here because that's what I invest in, but I also invest in self-storage, and there are several other options. It's not just about apartments. So as I mentioned, I invest in apartments. A lot of folks are out there investing in mobile home parks. Industrial has gotten more appealing as well, but it's not just limited to real estate either, or residential real estate. I personally know folks who have syndicated private jets. I know folks who have syndicated resorts and golf resorts. I actually know people who syndicated racehorses. I don't know the business case there. I'd never get involved with something like that. But when you're in the space, you need to pick one and really stick to it and not bounce around between them. And once you get a track record, maybe you can think about branching out a little bit, but especially in the beginning, picking a path and sticking to it is critical. So pick your asset class. I'm not here to tell you which is the best one or which is the best fit for you. Once you make that decision, pick it and move forward with it. But it's not just about the asset class. You need to pick your strategy. So I invest in value add multifamily, but it's not just any value add opportunity. I invest in multifamily, B class, built in the 1980s or newer, but not too new. If it's too new, then it's going to be like an A class property without a significant amount of value add. But I didn't start there. I've invested in C-class multifamily and have taken some lumps in that space, but we ultimately did well. But it's a little bit more of a struggle. So I've decided that for me, B-class value-add multifamily is really the best thing. But there are folks out there who do, again, ground-up construction in multifamily. I've got no interest in ground-up construction. I like existing assets with cash flow in place, but pick your strategy within whatever you're working on. So in self-storage space, a lot of folks will buy an existing facility and look to add square footage. Maybe that's the right fit for you. Maybe you want to build a new self-storage facility. Whatever it is, really narrow that buy box down considerably and know what you're looking for exactly. So once you know what you're looking for, you need to pick your role in the space. And kind of a dirty secret, maybe not dirty secret, but a secret of real estate syndication is that if you look around at these syndication businesses, some of them will look like there's one person running the show, a guy or gal. Maybe there's a figurehead, somebody out there who's more in the media, or their face is out there, their name's more tied to their business. But the reality is that all of those companies have a lot of people working in them to make them successful. So for you, I think the first thing to really decide is if you're going to build a team or you're going to join a syndication team and add value in your own way. But whether you're going to build a team or join a team, you need to have a unique value add in the team. So that could look like whether you're going to do asset management. Are you going to do the underwriting? Are you going to build broker relationships? Are you going to build lender relationships? How are you going to get involved? Really define that as you're looking for partners or you're looking for a team that you can work with. How are you going to play in that space? Now, you'll note that one thing I did not say to think about doing is raising capital. Not that it's a bad thing to do. That's actually what I do in the real estate syndication space. The issue is that there are a lot of potential pitfalls with just raising capital for real estate syndications. So I have securities licenses to do that. That's hence all the disclosures at the beginning, and everything is compliance, wants me to make those disclosures, and that's totally fine. But in the syndication space, there are people out there who are not playing by the rules when it comes to raising capital and that being your only role in the deal. My opinion is that's not the best way to start in real estate syndication. Take a more active role, learn the ropes, learn what good deals look like. And if you want to ultimately shift to raising capital, great. Just focus on, again, doing it in a compliant manner. I would suggest not getting started in that way, but if you want to, do it in a compliant manner. So after you pick your role, start building a brand. Whether you're going to build your own team or join a team, start putting yourself out there in some way that's going to get people associating your name, your face with your particular strategy. Pretty much everybody has some form of social media these days, whether it's Facebook. I'm not a huge fan of Facebook, but I have Facebook. Start putting yourself out there as someone who's investing in multifamily, put content, put information out there, because you're going to need to start building your investor list. Start bringing capital to the table, start building partnerships, but start putting yourself out there before you're doing deals, whatever. Don't be advertising deals, but put content out there, put knowledge out there so that people will start associating you with the business. And then you can start being magnetic in the space. And actually I have another book sitting here on my desk, a great book, Victor Menashe, Magnetic Capital. But think about being magnetic, and whether that's advertising your business and building that brand, or just building your own name on your own social media as someone who's in real estate. Start doing that sooner rather than later, because you're going to build that muscle, work that muscle, and start building those connections. Okay. Big decision that I think a lot of folks in the beginning, when they start in real estate syndication, aren't quite selective enough about, and that ends up slowing them down a little bit. And what I mean, so picking your market. So when getting started in real estate syndication, the temptation is to say, okay, I need to build all of this deal flow. And the best way to do that, and again, this is the temptation, is I'm going to look at the whole country. I'm going to look at 20 different markets and I can get all these deals coming in and start looking into them. But the problem is when you do that, you don't understand the markets well enough to accurately underwrite the deals. So in my opinion, newer investors should stick to one, maybe two markets, but not go any broader than that, and really hone in on those areas and get to know them very well so that when you get a potential deal in your email inbox, you can pretty much look at it and know whether it's a good deal or not very, very quickly, and get back to brokers in a prompt manner, make an offer quickly, or whatever you need to do so that you really know what you're looking at and can chase things down. And it can be tough to do, right, to make a decision and pick a market. And I'll give you a couple of ways that folks look at selecting their market. So generally, at least in the multifamily space, right, we look at the local economy first. Number one being jobs. Is there job growth? Are there people moving there to get their jobs, moving there to work, right? Because how do people pay their rent? They pay their rent by working. We need to know that there's job growth and population growth, because there are markets around the country where the pricing may look attractive, but the population has been in decline for 30 years and it just looks cheap because maybe we're comparing prices versus prices in California or prices in Northern Virginia or higher, more expensive areas. Just because it's cheap doesn't mean it's a good investment. We want to look at the local economy first, look for job growth, population growth, and then especially in multifamily, economic diversity is very, very important for recession resistance as far as our general market goes. And what do I mean by that? Well, I'll give you a more specific example. So a number of years ago when oil prices were very high, we were doing a lot of drilling in the Dakotas, and there was a real estate boom in the Dakotas. Well, what do you know? Oil prices fell, and that decimated a lot of those newer real estate developments in the Dakotas because those areas didn't have economic diversity. The only thing going on was oil drilling. And in my opinion, prudent investors would look at that and say, okay, well, all the jobs here are oil drilling. If the price of oil dives, which can happen, does happen all the time, those jobs are going to go away and our market's going to disappear. So it's not just about oil. Just look at the local economic diversity. Folks have different numbers in their heads about what qualifies as diverse versus not diverse. I'll let you make the decision for yourself about what is economic diversity for you, but look for a variety of industries. Make sure there's not one mill that everybody works at, that, if that mill shuts down, the market's going away. You don't want to be in that situation, left holding the bag. And then supply and demand of your asset class. So multifamily, for the most part, in most markets, it's not a problem right now because we haven't really built that much real estate in the US for the past decade. It's still possible that can change, right? You still want to look at those numbers and make sure your area is not heading into some kind of oversupply for multifamily if that's what you're investing in. Self-storage is one where some markets are actually overbuilt in self-storage. Self-storage investors will look at 1, 3, and 5 mile radii around their property to look at the supply and demand, whether it's oversupplied, undersupplied. You can also look at drive times, but whatever it is for your asset class, look at the supply and demand and make sure that dynamic is favoring, your asset and the pricing of your asset. You don't want to be in an oversupplied market, no matter what you're investing in. And then, of course, business friendliness, it's about, can we get people out who aren't paying, is how onerous is that? Just things to think about, but really narrow it down. And y'all might be thinking to yourselves, well, okay, it's still a big country, right? That leaves out a couple of these markets, but still a huge country. Well, I'll give you a couple of ideas that can help you narrow it down. You don't have to do these, just ideas in case this doesn't quite narrow it down enough for you. It just doesn't give you quite enough of a jumping off point to quantify those metrics. So I'd say you can write down a list of 10 markets and look at those, but to narrow that down even further, think about starting with what you know. So you're in California, maybe you lived in Northern Virginia for a little while and Virginia a little bit better. That can be a great place to start. Or maybe you're from the Midwest. Maybe you know Omaha pretty well. Start looking at Omaha. Maybe you conclude that that market's not a good place to invest, but it's a jumping off point and can get you started in evaluating your markets. The next thing, so the Northern Virginia, this might disqualify that, but think about your travel distance. So if you're in California, it may not be the wisest decision to commit to Atlanta, for example, because you might get a call from a broker on Monday saying, hey, can you come look at such a property this week? It looks like it's going to be a great deal. Well, you're going to say it's going to take me basically a day to fly there, day to fly back. I can't do it this week. How about next week? Well, next week's going to be too late. So think about how your travel distance and travel time impacts your ability to be competitive in a market. And again, I'm not telling you what decision to make or what metric to use, just something to think about. I know folks who have used the metric of, I don't want to have a layover. I want to be able to take one flight to wherever I'm going. That's an interesting thing to look at. Or I don't want to be more than one time zone away from where I live. I don't want to be investing more than one time zone away, or I don't want to be more than 2 hours flying, or things along those lines to narrow the whole country down to a couple of markets that you can evaluate and move from there. Again, things to think about. But once you pick your market or markets, two, don't go more than two though, especially in the beginning, build relationships. So you need a lot of relationships in the area, huge ones, big ones for multifamily investors in particular are brokers. Probably 95 out of 100, maybe even 99 out of 100 large multifamily deals go through local commercial brokers. And most markets will have just a handful of brokers who control maybe 80% of the deal flow in the area. You need to build relationships with those brokers to get on their list and start seeing their deals. But you don't want to start by just calling them up and saying, hey, I'm looking for deals in your market, send me one over. Brokers are very protective of their time and reputation. So when you're approaching those brokers, you need to be able to demonstrate to them that you're qualified, you understand what you're looking for, you understand their market, and you can close on a deal. You're a good use of their time and their reputation. And in order to do that, there are other pieces you want to get into place. You want to talk to various service providers. Again, if you're multifamily, you need to have property management lined up or kind of know who you're going to use, who you're going to work with. So you can drop those names with brokers. I'm going to be working with such and such property management company. I'm looking for B-class assets in these particular submarkets. Lenders are good to have lined up. It's not necessary always to have a lender in your local market, especially multifamily. It's not as important. Mobile home parks are a bit of a different situation where local lenders might prefer, that's a little more murky of a lending environment. But get those pieces in place, really, especially before you start calling brokers if you're in multifamily in particular. And again, the strategy you're pursuing might call for having your own relationships with contractors or general contractors or builders. Just think about that ahead of time as you get those pieces in place, but build those relationships earlier rather than later. Get those pieces in place. When we're talking about building relationships, networking. Networking is so big in real estate. And this is something that, I didn't say this before. It might not seem like this because I've been talking to y'all for about a half an hour now. I'm a pretty introverted guy, right? I mentioned earlier, I have a degree in chemical engineering. I'm a nerd, right? I'm a technical guy, but sometimes, you got to kind of step out of your comfort zone to achieve what you want to achieve. And one of those things is getting out and building your network. There are a lot of syndication specific events that you can attend. Real estate guys are great. I've been to many of theirs over the years, excuse me. RE mentors are very good. Their ultimate partnering event is a great place to build your network. Just stand in the lobby and talk to people and build relationships. Rod Cleve hosts a lot of events. The Best Ever Conference, I go to that one every year. It's going to be in Salt Lake City coming up next year. Think Multifamilies also has a lot of events around. And then local networking. So locally, you might not be networking with other folks who want to get in the syndication space, but you might meet people who want to invest outside of California, for example, and okay, write that person's name down. Maybe they'd be interested in investing in one of your future deals. Start building those relationships with them, but really start putting yourself out there and building those relationships. And in that vein, I'll recommend a couple of business assets to start getting in place as soon as possible. So technology, it's pretty easy to build a website or hire somebody to build a website. If you're starting your own company or whatever, just get a website, a landing page up there with a form, make it look nice, get that out there, sooner rather than later. So you at least have some kind of jumping off point that adds legitimacy to your business. And another one, CRM, which you may not be necessarily familiar with, customer relationship management software. Not the customer part is not operative. The relationship part is operative here. There are so many options in CRMs. HubSpot, in my opinion, has the best free option. Once you get into their paid options, it gets pretty expensive pretty quickly, but their free option is very good. Personally, I use Active Campaign. Active Campaign's automations are the most powerful, really, that I've found across the board. There are a lot of options to build things, whether it's follow-up reminders or integrations with other tools. And it can be tough to pick a CRM if you're not satisfied with the free one from HubSpot. Just go do some free trials and figure out which one works for you, which one you like the most. But get that in place and start logging people in them, start taking notes about them, set follow-up reminders, whether it's brokers or potential investors. Get those in place and just start keeping touch with people and building your relationships up. And then I have people as business assets. Well, in business, you can either be asset or a liability. We want people to be our assets, right? So start building relationships with potential partners. And a big one for me that honestly took me a little longer to learn than I care to admit in hindsight is hiring people, hiring employees. And there's another book behind me, The E-Myth. It's all about working on your business rather than in your business. This is a lesson that was told to me many times by successful real estate syndicators who had done a huge amount of deals, is thinking about the dollars per hour that the tasks you're working on are worth. And if you're working on a task that you could hire somebody and pay them $8 or $10 or $20 an hour to do, then hire that person so you can focus on the $100,000, $500,000, $1,000 an hour task, because your time is the most finite thing that you have in any of these businesses. And it might be hard to, and it was definitely hard for me, especially at the beginning, to think of, okay, if I hire somebody, what am I going to give them to do? Like, I have the budget, but do I have the tasks? And one of the best things to do is get a piece of paper or a notebook and just write down all the stuff that you do over the course of the week. And eventually you'll figure out that, okay, some of these things are repeated on a weekly or daily basis, and I could turn them into a process. Okay, keep pulling on that thread, turn those things into a process, hire somebody, give it a shot. They're going to fail at first. That's okay. Just keep working through it so that you can have more of your time back to focus on those more valuable tasks. That's big. That lesson was taught to me many times, and I didn't listen for years. And then I started listening, and it helped us really take off in my business. So start hiring people really as soon as you can, maybe even before you can. So to sum it up, last couple of things here: get educated first, whether it's about how syndication works and the rules, or about how your particular business works, or really both of those. Get educated. Next up, you need to make decisions and commit to a particular path. I think this is really where most people who want to get into space kind of go wrong, or spend too much time, is making decisions and committing to a particular tack in this business. And then networking, put yourself out there, go to these events. You guys are here with us today. I certainly appreciate your time and speaking. Start building relationships and getting to know people, and then take action. I mean, that's committing and taking action is everything. And Rome wasn't built in a day, right? It's going to take a long time to start putting those pieces together, but that's the only thing you can do, is just put one foot in front of the other. If you'd like to get in touch with me, I'm happy to speak with you. I mean, Shalini just reached out to me. That's how I'm here with you today. Taylor at ntcapitalgroup.com, or our website is ntcapitalgroup.com. If anybody has any questions, I see maybe we have a couple of chat bubbles. E-Myth. All right. So Shalini, just a couple of comments there. Yeah, I mean, there are a lot of great books. I've got the E-Myth, Multifamily Millions by Dave Lindahl. Rich Dad, Poor Dad. I mean, that got me started investing in real estate. Everybody seems to know Rich Dad, Poor Dad. AJ Osborne's self-storage investing book is very inspirational. Never Split the Difference is great. And then I got to put, this is a jujitsu book. I got to put some jujitsu up there on the shelf. But yeah, I want to thank everybody for your time today. If you have any questions now, happy to take them, or later, shoot me an email. I'm, pretty easy to get a hold of.
Yeah, thanks, Taylor. That was super helpful. And for folks in the audience, please feel free to put your questions in the chat pod. You should be able to do that now. Before, while we wait for folks to ask any questions.
What was the book on storage?
Yeah.
It's Growing Wealth in Self-Storage. I think this is like $20 on Amazon or something. AJ Osborne. It's not a long book. You can see how narrow it is. And he has his own podcast too. But it goes through his journey of getting started. Another one that I don't get like paid, compensated in any way for this, but the Storage Rebellion is an awesome group. They don't have a book, but they have a forum and their own educational and partnering platform and everything. Look up the Storage Rebellion, join their forums. The forums are free, and just get to know people. Great networking atmosphere there. Mike from the Storage Rebellion, the founder, has been on my podcast a few times, and he's a great guy. And I think he and his kids and his wife spend, what did he say, like 4 or 5 months a year in his RV because he's got so much self-storage. That's what he wanted to do.
Awesome. So while other questions trickle in, Taylor, I wanted to find out more about your journey. How did you said you started off in with passive investing, or did you do like single family, small multifamily? How did you get started?
So my investing journey generally, not just in real estate, started graduated from college, well over a decade ago now, but had a few nickels to rub together as big boy money. And first book I picked up was The Intelligent Investor by Benjamin Graham. Basically just tells you, just go buy index funds and, try that. It was a good time to buy index funds, and I did pretty well, but ultimately wanted to make a shift to real estate investing. Spent a few years studying and learned about syndication, wanted to invest in syndication. So I started, my first step into real estate was passive investing in a syndication. So a couple things with that particular deal. We did end up making money on it, but the property manager stole money from us. The big lesson out of that was the property manager, this gets into the weeds a little bit. I've talked about this on podcasts, but the property manager had equity ownership, had general partnership interest in the deal, but wasn't a part of the sponsorship team necessarily. So he started to feel entitled to more compensation, stole money from us. And then once that was discovered, it turned into a legal battle with the sponsor. And so that was a big lesson there. I think we were a little bit saved by the market on that one. Spencer, my podcast is the Passive Wealth Strategy Show. I got Ben Franklin on there from Money on our title card. So anyway, passive investing is how I got started. Honestly, the mistake, I think about this a lot. The biggest mistake that I regret in real estate is not a particular deal. It's that I used a self-directed IRA, and I still have that self-directed IRA invested now in a different deal. It's been years that went by. And it's not because there's anything wrong with the self-directed IRA necessarily. It's that the administrative, it's just a nightmare. I have to hire a separate CPA. I have to have this custodian and shuffling the paperwork. It's honestly, the taxes for my self-directed IRA are worse than my taxes, and my taxes are complicated, but it's just because that's such a specialty area. So, there's so many folks out there, custodians, talking about how great a self-directed IRA is. I don't think there's anything wrong with it, but to me, it's just an administrative nightmare. And, I regret that. And once that deal sells, I'm not doing a self-directed IRA anymore. I don't care how many penalties I have to pay. I'll pay them. It's too much of a headache, takes too much time.
Okay. Good to know. So what I found interesting that you mentioned is that you were off trying to learn about investing in stocks, and a lot of folks here, we are more active in the stock market than in the real estate investing space. So what was the trigger to start exploring real estate in addition to, what made you pivot from that Intelligent Investor book, investing in index funds, to real estate?
Sure. So honestly, I was just doing the math on, okay, where am I going to be? Okay, so today I'm 33, but when I was 23, I was thinking, where am I going to be? When I'm 33, where am I going to be? 43, 50, doing the math down the road and seeing that, okay, these index funds aren't going to get me where I want to be. And really, in my opinion, I think that comes down to cash flow. And I read Rich Dad, Poor Dad. I read a different copy. I've since lost the first copy that I had, but I read that, and he talks about cash flow and everything. And at the time, I was also thinking very heavily about getting an MBA. I also, again, at the time, had a job where I was flying around the country every week, drive 2 hours to get to the airport, get on a plane, fly to California. I went to California a lot, spend a week there, fly home, get home at 1 a.m. on a Saturday, get back on a plane on Monday. It sucked. But I had so many misgivings, and I saw that, okay, if I get an MBA, I'm going to have all this money in debt, basically all this opportunity cost and everything. And then what am I going to be, a consultant and spend my time flying around the country again? don't want to do that. So for me, it was really a combination of things. I saw that stocks, you can't create value as a stock investor. There's nothing I can do other than buy and sell at given times for given prices, but I can't control what actually happens with the company. And I saw that real estate, we have that opportunity, to do it. So it's a whole confluence of, years of events summed up in, a minute.
Yeah. So the other thing is that, a lot of folks in this group, they are real estate investors. They started off with investing in, let's say, buying a few single family homes or with small multifamily. And they're thinking about, okay, how do I scale this? Right. So you shared a few options. Then there is this big question mark of, okay, I enjoy my full-time job. I see, whatever the intellectual stimulation and all that stuff is something, it's not that I'm dreading but to go to work every day. Balancing that with something, being a general partner in syndication, how, is that possible? That's the biggest question mark that folks have. And is it even viable? What are your thoughts on that?
So syndicating deals is a lot of work. I mean, it's not something to take lightly, especially when you're taking on passive investor capital. You have to take that seriously, and people will expect you to take it seriously when you're taking their money and investing it for them, basically. So, again, as I mentioned earlier about committing and taking action. I mean, if you want to actively syndicate deals, it's work. And if you want to succeed, you're going to give up, nights and weekends. I mean, that's just the reality. We're like, and maybe it's the Gary V hustle thing, stop taking time off. But if you want to do it, you want to scale, you want to do these deals, it's a big time commitment. It's another job. Syndicating real estate is not something you do passively or part-time. Got
it. Okay. So it's practical, but go into it with your eyes wide open. It is involves a lot of hustle.
Yeah. And it's just and at first, when you're getting started, you don't know exactly where to go. I mean, I can give you this conversation, I can give you, a roadmap to take, but you need to know what step you need to take on a daily, weekly, monthly basis. And it takes a little while for any given individual to start figuring out how exactly their fit in the business is going to be. And that just takes time. But the only way you figure that out is by putting one foot in front of the other and falling on your face and, making mistakes and sometimes getting embarrassed, but, whatever, it's okay.
Yeah. Okay, cool. Any other questions? Yeah, I'm just looking at the chat pod. feel free to unmute yourself also if you want to directly ask your question. Okay.
Quiet group.
It is a quiet group. Cool. What advice, Taylor? So, I think one takeaway for me listening to your advice was that avoid overwhelm at any cost, right? So make decisions at every level, be it, when it comes to figuring out your buy box, figuring out what your market is, figuring out what your investment strategy is. If someone in this group is thinking about, hey, I want to explore syndication as a possible path, what would you advise in terms of, the first next step or first a few questions that they should ponder about and take action?
So if you're really just getting started, I would say start listening to podcasts about real estate syndication. I think that's probably the easiest foot to get in the water. There are also quite a few like free online networking groups that you can join that really get into the weeds. I host a monthly webinar and we'll bring a syndicator in. I got one coming up about RV park investing. Start joining those and ask questions and there's so much that you can learn for free or really cheap, and that's what I would do. I mean, it's going to take your time to learn the things. Yeah. But yes, start using those free resources or cheap resources that are out there, and just start putting one foot in front of the other. Something to consider doing is consider to do now, not for anybody attending, but start a group amongst your coworkers to have guest speakers in and talk about real estate syndication. That's a great way to get started. Just keep putting one foot in front of the other. And when you're just getting started out, I think just learning what the space looks like and gravitating toward what sounds right for you is really how you get started. After working on it for a while, you stop having questions about what do I need to do today when you've made decisions about this is the market that I'm investing in, this is the asset class that I want. And these are the pieces that I know I need. I know I need a property manager. So today I need to find a property manager. I need to work on finding a property manager, whatever. When you've made those decisions, you have that roadmap in front of you, once you've learned the asset and everything. So you no longer have those questions. So that's, I think, the power of learning how the business works and then narrowing it down for yourself. And, what's my participation in this space? Am I building a team? That's why I talked about building a team or joining a team. Well, okay, maybe I don't want to be the person building a team. I want to join a team. Great. What's my value add going to be? Okay, my thing now is I need to figure out what my value add is going to be. So I think just focus and execution really help you move forward more quickly. I mean, it's like pushing a this might not be the best analogy for Californians. It's starting to get cold here in Virginia, but pushing a snowball, right? You getting it started.
Yeah. Okay. Cool. Awesome. We don't have any more questions on the chat bar, but
hey Taylor.
Yeah, what's up, Spencer?
Yeah, I've got a quick question for you. So you mentioned the RV park webinar that you're putting on. How can we get there? How do we get there?
Sure. So I can send Shalini the direct Zoom registration link, or you could go to, let me look up it's passivewealthstrategy.com, or I could send it in the chat here. Let me give me a second.
Yeah. Sweet. Yeah, because I personally haven't ever even thought of RV parks, but I have a buddy that's super interested, and so we've been talking about different strategies and things like that. So would love to join the webinar, hear more about that. And then what podcasts would you recommend? Obviously, I'm definitely going to look into yours, but are there any others that you would recommend? I mean, I listen to Bigger Pockets, but I don't know if there's any others that are specific to more syndication, multifamily kind of stuff like that.
Sure. So Bigger Pockets is a good platform. I think, Shalini, you found me on Bigger Pockets. I'm very active on the Bigger Pockets forums. I spend a lot of time on there. I took all my Reddit screw around time energy and put that into bigger pockets to try to make it productive. So as far as podcasts go, a friend of mine, Whitney Sewell, produces the Syndication show. That's a daily show, and he's a great guy. So I definitely recommend checking out Whitney's show.
What's the last name?
Sewell, Sewell. He hosts. I'm going to try to pull up Michael Blanc's show is also very popular. I'm trying to find the Real Estate Guys show is pretty good. It's not as real estate syndication specific. Like Bigger Pockets is not going to really teach you how to syndicate a property.
Exactly.
Rod Cleef's show, Lifetime Cash Flow Through Real Estate Investing, is pretty good. He does, talk a bit about his coaching program and everything. So, just prepare yourself for that. There were some questions about self-storage. I think you might have even asked that question, Spencer. There's AJ Osborne's podcasts, Michael Blanc's podcast. I'm just sending these in the chat. But there are quite a few out there. And if you search, I love YouTube. I'm more of a YouTube guy than a podcast guy, to be honest with you. I even pay for the YouTube premium, so I don't have to hear the ads. But search real estate syndication on YouTube. If you're looking to learn about like attorneys in particular, two folks, Kim Lisa Taylor is a syndication attorney. She has her own podcast, syndicationattorneys.com. And then Mauricio Raould has a YouTube channel as well. So there's a lot of great, there's so much content out there. It's more short on time than content.
Gotcha. Very helpful. Thank you, Taylor.
You bet.
Yeah, thanks for sharing all those resources, Taylor.
Yeah, no problem.
So final call, any other questions, folks? Okay. Awesome. Yeah. Thank you, Taylor. I'm so glad that you were able to join us. And for folks here, Taylor gave us some wonderful resources. I will put that in the presentation when I share it with the group.
Awesome. Well, thanks so much for the opportunity, and look forward to meeting you guys offline or whatever.
Yeah. All right. Have a wonderful day. Rest of the day, everyone. Thank you. Bye.